Well, hello, everyone. Cynthia Tomane with Interactive Brokers, and thank you for joining today's webinar, where we'll be discussing low interest rates that may push the S&P into new territory. I'm very pleased to have with us today Michael Kramer, who is the founder and CEO of Mott Capital Management. So with that, Michael, thank you for joining us. I'm going to go ahead and pass you the controls. If you could share your screen, we'll go ahead and get underway today. Thanks for joining us, Michael, and welcome.
Hi there. Thank you for having me, Cynthia. Hopefully everyone can see my screen okay.
Looks good.
Perfect. Thank you. So we'll begin. Thanks for joining me today. I really appreciate everyone coming and sharing in this with me. I hope that you find this as enjoyable as I did creating it. So I think everyone knows that we're in a low interest rate environment today, and I think for a lot of people, they're not understanding, at least for some investors, what that actually means and why that actually is supportive of a stock market that could rise over time. Basically when we start, this is just a quick disclosure page, by the way, like Interactive just did, but basically this period of monetary policy around the world is really what's driving these interest rates lower. And when we think about what that means, it basically tells us that, one, global growth is slow, right? So that people in places like Europe, in Asia, are struggling to get their economies moving faster. Some data out of some of those countries recently suggests that, they may even be entering, recession. But that hasn't really been the case here. But there's been a lot of talk about the Fed cutting rates despite that. And I'm going to really try to get into some of those concepts today, why the Fed is going to probably cut rates and why that's actually a positive for the stock market. And I think that, I'm sorry, I just need to try to fix my screen here. Sorry about that. And so what's really been driving the Fed to cut rates? Today, just this morning, Chairman Powell in his testimony noted that, there were still signs of slowing, and there were certainly risks to the economy. And some people would point to the strong jobs number on Friday and say, well, how is that possible? But it's not really about jobs. It's not really about GDP growth. It's what's really been weighing on the economy here has been inflation. And low inflation rates around the world are one reason why you have an ECB which has negative interest rate policy, Japan which has interest rate negative policy, and why their bonds are trading at negative rates all the way out to 10 years and more. And this is really, these low inflation rates around the world are causing these banks to take some extreme measures in trying to stimulate growth. But what happens here is that there's an effect that low rates around the world make our rates very attractive to investors from those parts of the world, and that causes dollar strengthening. The dollar strengthening actually works as a deflationary force on the U.S. economy, and that drags down our inflation rates. So in my view, the Fed has no other option but to cut rates to try to stimulate inflation here. And on the next slide, as we get into it, you can see that basically inflation here in the U.S. has really slowed recently. Basically, we had gone through a period of higher inflation rates, but starting in the middle of 2018, that really began to slow. And we could think about, in October, November, when the stock market was heading lower, what was one of the big things that everyone was watching as the stock market was heading lower? It was the price of oil. Oil is one of the biggest components to inflation. And with oil heading lower, that's put a negative force on inflation rates here. And so when we think about what this means, again, it points to the fact that over that period of time, we had a Fed that was raising rates. Remember that the Fed raised rates by 25 basis points in December. And we had a policy in Europe and in Japan and other parts of Asia that was more accommodative. And that was leading to dollar strengthening here in the U.S. The dollar advanced quite significantly in 2018. And again, that had negative forces on oil as well. Remember that when you purchase a commodity, it has an inverse relationship to the dollar, so that as the value of the dollar rises, it takes fewer dollars to buy the same unit of that commodity. So this is really, when we think about what's been the driving force of the low inflation rates here in the U.S., it's not just a function of the U.S. economy, it's a function of the global economy. And we need to think about investing today not only from a U.S.-centric viewpoint, but from a global viewpoint. And my viewpoint has been actually for a number of years that we're in a low inflation environment, and it's likely to remain that way for a very long period of time. And I get this concept a number of years ago when I was doing some research and work on the velocity of MZM, which is money. And MZM is the overall money supply in the U.S. And when I was doing the work, I didn't really think about what I was potentially stumbling upon at the time. But the velocity of MZM, people have fancy definitions for what it is. In my mind, in the simplest form, it is just a mathematical equation, and that is a ratio of nominal GDP divided by the MZM money supply, and that's all that it is. But what it creates is this interesting chart, right? And what it tells us is that in the 1980s, for example, in the early 1980s, $1 in MZM created about $3.50 in GDP, right? So that if the government was printing money, the dollar that was created in MZM yielded $3.50 in GDP. But that has changed dramatically over the years. GDP today, $1 in MZM creation only yields $1.30 in GDP. So basically, GDP creation today is far less efficient as it was earlier in time. Basically, we're not getting as much out of every dollar as we used to, which in my mind is what creates this disinflation or lower inflation rate environment. And it sounds like a crazy concept, but I'm going to show you a next chart that kind of validates that. This is a chart where I overlay the 10-year Treasury rate with the velocity of MZM. And so what this is showing us is the correlation and how strong the two actually are. And when we think about what yields are simply a derivative, or they're derived from what investors believe future inflation will be. So in other words, if I want to invest $1,000 today and I want to put it in 10 years out, I'm guessing that my inflation rate is going to be 2 or 3%. So I want to at least earn that and more in order to make that investment worthwhile. And so if interest rates are a derivative, or if they're derived from inflation, then that tells me that the MZM money supply and the velocity of it is actually a measure of inflation. And when you look at this chart, we can see that it has declined rapidly, and it shows no sign of turning higher at this point. And with low top-line GDP growth, slow, right, it's going to make it very hard for that velocity to turn higher. We need to see substantially faster GDP growth in the future to make that ratio begin to rise again. The only other alternative would be to have less MZM in supply, but that would obviously create other issues. And so when we think about this low inflation environment, we have to think about it outside of just the U.S., because it's not just the U.S. that has low inflation. In fact, Europe has low inflation. The CPI, if you look on the right-hand side of the chart, has dipped in the month of May to 1.2%, right? And that's down from readings of over 2% in October of 2018. The first quarter GDP rate of growth in Europe in the first quarter was 1%. That's down from 2.5% in the fourth quarter of 2017. So it's not just slow growth and low inflation here in the U.S., it's happening abroad. And that's causing, and so while the Fed has been tightening monetary policy here and raising rates, the ECB has been going the other way. the ECB has had an easy monetary policy for another number of years, and it's actually indicated that it may get easier in the future. And so what happens when interest rates are rising in one country and falling in another country? It makes the value of the country with the higher interest rate more attractive in terms of people investing, and it strengthens the currency of the country that has the higher interest rate. In this case, the U.S. has the higher interest rate, and therefore we have the stronger currency. This is a chart of the dollar versus the euro. Now, if we look at 2008, it took $1.60 to buy 1 euro. If we go to today, it takes about $1.12 to buy 1 euro. That's how much the euro has weakened in a number of years. And again, why do we care about what the currency rates are? Because a stronger dollar weighs on inflationary forces. It weighs on prices of commodities. It pushes prices lower, and that's a negative and a drag for readings like the CPI, the PPI, and the PCE numbers. And you can see again here in this chart, this is of just the dollar index. Now think back to 2014 and 2015. I didn't put the slide in, but what would happen in 2014 and 2015? The price of oil plunged from $100 a barrel or $115 a barrel, and it plunged as low as almost $25 a barrel in 2016. That's not a coincidence that during that same time, the dollar strengthened materially. So I think when we think about how these things relate, we need to think about it in terms of what is the driving force. It is geopolitical, macro, central bank policy that is the driving force between inflation here in the U.S. and what's really happening in the environment. It is not. We are not an island unto ourselves. We need to think about things we need to think about them on a macro level. So people have been taking this notion that these lower interest rates here in the U.S., these plunging rates that we've seen in the yield curve inversion, and they've been taking it as a sign of recession. In fact, this morning, I think the 30-year bond crossed below the 3-month bond for the first time. And I think that, number one, we're not heading to a recession. Low interest rates and the lower interest rates we may see are really more of a function of what's happening around the world and the low inflation rates we've seen and the dollar strengthening, as I just described. And so you can see on this chart, one way of measuring the yield curve, which is most commonly used, is taking the 10-year Treasury rate and subtracting it from the 2-year Treasury rate. Well, generally speaking, people will say, okay, when the yield curve inverts on the 10-2, it's a sign that we're heading to recession. And as you can see in the chart below, the green lines that are vertical represent recessionary periods. But this, I'm going to draw in a little red line for you so you can see better. Right here, you can see is the 0 point, right? So you can see at this point, we're still not below 0, right? But in the past, we have fallen below 0, inverted, and then we went into recession. So at this point in time, there is still a positive spread between the 10-year and the 2-year, which would suggest to me that, A, we're not heading to a recession. Another characteristic of the 10-2 is look at how deep and how far negative they went into negative spreads. This one in the 1989 period was almost as low as negative 50 basis points. In 2000 and around the year 2000, it was even lower. And in 2007, again, it was around negative 20 basis points. But then also consider the fact that look at the duration. Look at how many years passed from the time it went negative until the time it returned. 2 years. This is probably a period of about 2 years. We haven't even gone to that point yet. So the yield curve today isn't necessarily pointing to or reflecting the idea that we're heading towards recession. What it's telling us is that we are in an environment of low rates around the world due to low inflation and that is the reason why we're seeing these inversions in the yield curve. Another sign that I point to would suggest we're not heading to a recession is the ISM PMI reading. In fact, last month's reading just came out a week ago, and it suggests that the U.S. GDP is growing at a 2.6% rate in the second quarter based on that reading. And you can also see that the ISM Manufacturing Index historically, again, the green lines representing recession, had to fall below 44 before it actually indicated that we were in a recession. Today's reading is not even close, around 51.6. So again, I think we're very far from a recession, and it really all comes back to the global macro picture, which is lower rates around the world are making our bonds attractive to other investors, which are pulling them into our markets, and dollar strengthening is causing deflationary forces to take hold here in the U.S. And if you don't believe me, you can look at another chart, which I have here, which shows that the spread between German bonds and U.S. bonds are near historic highs. It actually reached a spread point of 3% at one point in late 2018. You can see right here, this is what I'm pointing to, and you can see the only other time in history that happened on this scenario was in the late 1980s, nearly 30 years ago. So that's how high bonds are. The spread is between German bonds and U.S. bonds. And as that spread contracts and returns to normal, or returns to a norm, let's say of 2% for this case in this period in here, like in here, that would mean that either German bonds need to rise, right, which isn't likely to happen in a scenario where the ECB is easing, or U.S. Treasuries need to fall, which is much more likely in a scenario where the Fed may be starting to cut. And when we look at the 2-year Treasury yield, this is an older slide, so it's a little bit dated in terms of a couple weeks, so things may have changed a little bit. But the 2-year is basically on the cusp of breaking below, or is broken below, a key support level at 1.83%, and I believe that can send the 2-year down to 1.5% over time. The red line on the top represents a major long-term downtrend, which we are failing against, and you can see we've broken an uptrend, which would be this line right here. So now, if we've determined that low interest rates aren't a function of a recession here in the U.S., they're a function of macro forces from around the world pushing inflation rates lower, making the dollar stronger, and it all being a circle. So if that's the case, then why are equities not doing anything, right? And is the equity market really cheap at these levels? And my answer to that is yes, it is cheap at these levels, especially when you compare it to bonds. What I have here, I took the S&P 500 dividend yield, and I took that and I compared it to the 10-year Treasury rate and created a spread, the U.S. 10-year Treasury yield versus the S&P 500 dividend yield. And you can see on the chart I've circled 3 times that the spread has inverted, meaning that the S&P 500 dividend yield was actually greater than the 10-year Treasury rate. It's only happened 3 times since 1994. 2009, a period of 2011 to 2012, and a period of 2015 into 2016. So why are those years important? Well, you'll see on the next slide, which has really become one of my more favorite charts. But you can see here currently we're near that point of inversion, which again would suggest to me that we are probably at a point in time where the market is going to begin to turn higher. This next chart really demonstrates that, right? Again, it was in 2011 and 2012 that the equity market was stagnant, right? And that was a time when we had the sovereign debt crisis going on in Europe with Greece and Brexit. And then you had the U.S. debt downgrade in that summer of 2011 with an equity market that basically went nowhere. But once it broke out, it went on to rise substantially. Again, in 2015 and 2016, the last time I showed you on that chart when we inverted, that was another period where the equity market basically went nowhere for over a year and a half. And today is no different, because today we have gone nowhere for 18 months. The S&P 500 is up about 4% since January 26th of 2018, another 18-month period of consolidation. And so when we think about what those inversions signify, or that low rate versus the 10-year Treasury, it signified good opportunities to be in the market, eventually leading to higher equity prices. We can also measure the market on a different metric, which is earnings, right? Earnings, in large part, have been trending lower since the beginning of the year. This is data that I compiled from S&P Dow Jones. It shows that we're currently expected to earn about $163 a share in 2019 and about $183 a share in 2020. And I actually calculate my own earnings estimates. I've developed a model for doing that. And I am modeling about $182 a share for the S&P 500 in 2020. So why is this important? Because the next slide really shows it. Currently, the S&P 500 is trading at about 16 times one-year forward estimates, right? So 1 year forward, 2020 earnings estimates of $183 a share. Historically speaking, in 2017 and 2018, the S&P 500 traded at about 17 times 1 year forward earnings. And they go back even further to 1988, according to the data I compiled and went through with from S&P Dow Jones. We traded on average at 17.5 times 1 year forward earnings. So today, by today's standard, at 16 times, the market may be too cheap, based even on a PE multiple number. If we approach that number closer to 17 to 17.5, you're talking about an equity market that gets closer to 3,200, maybe even 3,300. I've also have another way of thinking about this. So this is my own model that I use, and this is off of the $183 I told you before. Currently, the S&P is trading at around 16 times earnings, right? I took it one step further and said, well, what's one standard deviation of that? I have my model to figure it out, and I found that in a worst-case scenario, if the S&P earnings were to fall to about $172.50, which would be about a 5% decline. At a worst-case scenario, the S&P 500 is fully valued today, trading at about 17.5 times 1 year forward estimates. But if it turns out that the narrative that everyone is worried about, this slow growth and recession fears, turns out to be wrong, and we don't have the slowdown that we've been expecting, and earnings estimates actually begin to rise, I see a one standard deviation best-case scenario up to $193 a share, which would currently put us at only 15 times 1 year forward estimates. So when you sum it all up, we need to think about what's happening in the equity market, starting with the basics on the macro level. We are in a low interest rate environment because you have central banks around the world searching for inflation, and they're doing that by lowering interest rates around the world. Our bonds are becoming more attractive due to this, which is causing foreign investors to come into our markets and buy our bonds, pushing yields lower. Which, by the way, I was doing some research overnight for an article I'm working on that showed that we actually have higher rates here in the U.S. than they do in Hong Kong and Singapore, and we have the same rates that they have in Thailand. We have higher rates than in Italy. So it really goes home to show just how attractive our yields are to other investors around the world. And when you take this and then you think about what that means, it means a stronger dollar. It means deflationary forces at work in the economy. And that would leave the Fed only one option, and that is the cut rate. In plain English, they probably tightened too much. And in an environment where the 10-year Treasury yield is likely to continue to fall in the future due to these interest rate cuts, you can see that the interest rate, the S&P 500, as compared to the 10-year Treasury yield, is likely getting to the point where it is either currently too low and it should rise in value, or it will be in the very near future. And if earnings estimates continue to hold up the way that they have, where they just continue to drift lower at a slow pace and don't manage to get to my worst-case scenario, then the S&P 500 probably has some significant upside to it from here. This point, I'm going to open it up to Q&A, and if anyone has a question, I'm happy to, take as much time to go through it and make sure I explained it, explain the answer fully.
Now, Michael, I'd like to remind everyone that if you do have a question, keep in mind that control panel over on the right-hand side of your screen. Simply double-click the questions title bar, and you can pose any questions you might have for Michael at this point. Now, before we do get into Q&A, Michael, what I'd like to do is I'm going to grab the controls for just a moment and show folks how you can access Mott Capital Management through the Interactive Brokers website. Now, notice here I've brought up our website, so you should be able to see underneath the products menu, you'll find Interactive Advisors, of which Mott Capital Management is a part. By going into this section here, notice that you've been taken into the Interactive Advisors platform. Now notice what I am going to do is simply type Mott in the search button, and you can find Thematic Growth is available here, and read up more about Mott Capital Management. So there's quite a bit of information that's out here, and did want to show you how you can access that. So with that, I see some questions are coming in. What I am going to do is, Michael, I'm going to pass you the controls one more time. If you would go ahead and share your screen and then answer those questions, we'll take this back over to you. So thanks, Michael.
Sure. So it looks like the first question we have is, how do you think about equity positioning in this environment? What sectors and industries make the most sense to you now? So I think currently in this environment, right, we are in what I consider to be a risk-on environment, meaning that the sectors that are going to perform the best are the ones that offer investors the greatest earnings growth. Think about sectors like technology. Think about some of your consumer discretionary names. And I think that's kind of one way to think about it. Another way to think about it is, well, if yields are going lower, then perhaps some higher dividend yield stocks are likely to perform well. Think about your telecommunication companies that offer, these high dividend yields of 4, 5, 6%. For example, if yields are on the spreads are 400 basis points, and even if those spreads contract a little bit, it's going to have upward pressure on the price of the stock. So I think consumer staples can be attractive from that standpoint. Even utility stocks may be attractive from that standpoint. I think that if you're looking to invest in those type of sectors, that's probably where you're going to see the most benefit. I think some of the sectors like industrials that are more tied towards like economic sensitivities may struggle in this type of environment because people are so worried about the potential for, slow growth or recessions in some countries. The next question is, my thesis has been that a slowing growth environment, investors should own yield plays and secular growth. What do you think is the whole in my thesis, if any? I don't really see much of a hole. I think I actually kind of agree with that thesis. I think that we are in an environment that has low interest rates, and so it makes stocks that have higher yields more attractive. I think the names that have the really big earnings growth are likely to benefit during this time because they have the earnings growth and the growth to kind of offset the slow environment in around the world. And I think investors are always willing to pay a higher multiple for that growth. The question only becomes, what multiple is it that investors are willing to pay? Typically, in low rates environments, you get what's called multiple expansion, which means people are willing to pay higher earnings multiples, a higher PE ratio for a stock that offers superior growth. But that being said, if volatility were to persist, you could see multiple contraction, and that could actually cause people to be less willing to pay for some names. So I think you really have to kind of judge the environment we're in to really get to figure that part out. another question here. What are choice instrument sectors for investing in terms of risk and reward? So typically, in terms of instruments, if you want to play, the way I think about it is I follow a list of the 10 or 12 sector spiders, the ETFs, things like the XLF, the XLK, the XLY that represent a sector. That's one way you could certainly do it very easily. In other words, if you wanted to be, long technology stocks, you could just buy the XLK ETF, or you could do something along those lines. Another way to play it is to actually take the ETFs and then look at the holdings in the ETFs, and then go through it and select the 1 or 2 or 3 names that you like the best out of them. That's a way to kind of maximize the return if you're trying to play like a specific sector. But ETFs in general, I typically lean on the S&P spiders as being the best way to play the actual sectors. In terms of risk and reward, obviously, safer names are usually those staple stocks, those consumer staples, the names that seem to do well in good or bad environments, technology stocks, and those things that offer high growth have a smaller margin of error because should they miss or should their earnings reports not be as strong as investors want in a shaky environment, that may cause investors to unfairly punish those stocks, and that could mean that you could have significant downside risk in those type of names. The next question is, what do you think would be the impact of the trade war, especially if it does not end up well? So my general belief has been that a trade war will not have as big of an impact on the S&P 500 earnings as many people fear. I think that for the most part, as companies kind of come out and reiterate guidance or give guidance, we're going to get a better sense of what the actual impact may be. But when we think about what the actual size of the trade negotiations between the U.S. and China is, even when you factor in the number of the amount of goods that we send over to China or the amount of goods we receive from China, it's relatively a small percentage of the overall U.S. GDP. You're talking about like 1/20th, if even, of that, and so that's maybe 0.5%. So I've never been on the bandwagon that a trade war is going to be detrimental to the U.S. growth. I think there are companies that can stand to be really harmed in a trade war, but I don't think the overall economy or the overall stock market will really be overall impacted. And I think even to some extent, we already know what the impact is because if you think back to to May 1st, the market's initial reaction when the tariffs went on China was only about a 1% decline. People will argue that the market went down in the month of May because of the 6%. The 6% S&P decline was due to those trade war tensions. I actually believe that had more to do with the Fed being so kind of, I'll use the word lackadaisical during their press conference during the May meeting, and being kind of like not really willing to budge on rate policy. Because if you notice, come beginning of June, as soon as Powell made those comments, we took off like a rocket. And when the G20 deal, when Trump met Xi in the G20 summit, the market barely reacted to it. So I think most of that has actually already been priced into the market, to be honest. Next question. You haven't taken the geopolitical risks into consideration, which are staring us right in the face. How will those affect your calculations? So, yes, geopolitical risks, there are a lot of them. Obviously, Brexit being one. You have a lot of things going on in Europe with governments. That's certainly a consideration. There's always the risk of something happening that could be negatively impacted to the stock market. And unfortunately, some of those events are really hard to predict. So it's hard to factor that in. But which is also one way I do that is why I put in that one standard deviation kind of worst case scenario into my calculations because I always want to kind of know where I am in a worst case scenario. But I think that if things really start going awry, let's say in other parts of the world, it's going to lead to more central bank easing, and that will push yields even lower. And depending on which way those yields are going and whose yields are falling or rising, it could have an impact on the dollar. So yes, there's certainly always a risk there. How much of a risk factor is national debt? I don't really think that national debt is thought about much. I do happen to think that one reason why the velocity of money, in my research a number of years ago, one reason why the velocity of money has become so low, and the reason why we're seeing less productivity out of $1 created, is because of the debt. It has reached a point where it's actually having a negative drag on the U.S. economy. But I don't think people think of the national debt as something that they go to sleep about worrying about, because at the end of the day, the U.S. government has the ability to print money, and they can print as much as they like. And so, not saying that we want to be Venezuela, but certainly, there's ways that the government can kind of deal with that without necessarily it being something that's too much of a concern. And that's all the questions I see at the moment. I don't know if anyone wants to take a second here I'll give everyone maybe another minute to put something in. Otherwise, I think that's going to probably be it.
Well, at this point, Michael, what I would like to do is jump in and remind everyone that we have been recording today's event. And Michael, you've covered quite a bit of information. Thank you very much for the presentation here today. And do want you to be aware, if you want to come back and review the concepts that Michael went through today, simply watch your email later on this afternoon for a direct link, not only to today's recorded playback, but also to the slides and the charts that Michael used in today's presentation. So with that, it looks like we are approaching the end of today's event. You can all exit today's session with using the X in the upper right-hand corner of your screen. I want to thank all of you for participating with us this afternoon, and thanks for spending time on today's webinar. So with that, thanks everyone, and thank you to Mott Capital Management and Michael Kramer for today's presentation. Thanks everyone. Have a great rest of your day, all.